Hey folks, it's Simon here with your Tao Daily video newsletter for 2nd of May 2024. This is the price action for the S&P 500 yesterday, Wednesday, which was Fed Day, and had a lot of nothing, and then a big rally, and then a big drop. Now, at the peak here, the market was up over 1.1%. And that was after the release of, what was, I think, correctly interpreted as a fairly dovish statement from the FOMC. All of those gains were given back and more. The S&P actually closed in the red yesterday, down 0.32%. Now, for the S&P to be up 1% at 3 p.m. and then actually close in the red, it's a very rare event. Looking at daily trading history going back to 1983, the S&P would have had a 1% chance of closing in the red, 99% chance of closing positive. So, bit of a stumble there. And zooming out, I continue to think the path of least resistance in the short term for the S&P remains lower. At this stage, I'm not expecting the start of a major washout or a big bear market. But I'm entertaining the possibility of a pullback to 470-ish, which is sort of where the 200-day moving average is. I don't think we'll get there in a straight line, but I suspect that this won't be the low. Now, Powell in his press conference was very dismissive of the stagflation narrative, citing strong employment and strong economic growth. What we need to bear in mind, though, is that economic growth has dropped from 3+% to 1.6%, and all of the economic data that has been released, whether it's CPI, PPI, PCE, Employment Cost Index, the ECI, all of them are showing signs of re-acceleration and stickiness. We also had ISM Manufacturing out yesterday. That came in at 49.2, so that has slipped back into contraction. Remember, any reading above 50 shows expansion, any reading below 50 shows contraction. Now, not only did ISM Manufacturing slip back into contraction, ISM prices paid is the highest reading since July 2022. So prices are going up, whether it's ISM Manufacturing prices paid, CPI, PCE, economic conditions seem to be getting weaker, whether it's hard economic data like GDP at 1.6% or things like Chicago PMI and ISM Manufacturing at rolling over. So even though we don't meet the textbook definition of stagflation, given the very low unemployment rate and strong labour market, you can see why stagflationary fears could be emerging. That's what I got for you. I hope it helps. I'll catch you on tomorrow's update.